Are we on the brink of another NASDAQ crash, and has the bubble begun to burst on AI in front of our eyes? This is the question that many investors and traders like you and I are asking this weekend. And in today's video, we'll take a look at the data, the dark pool activity, and of course the flows to try to make sense of an unclear situation. Where are the key levels for the S&P 500, and were we expecting this weakness? Well, in many ways we were, and of course it was led many weeks ago by the semiconductor market. But that could be about to change, with the key level being hit that we need to discuss in today's video. NVDA, Bitcoin, and plenty of other things coming your way in today as we cover stocks, commodities, and cryptos in our special weekend edition. Let's get into it. There's heaps to discuss. Well, welcome back everyone to the special weekend edition. My name's Tom. Today we're discussing the macro, the data, and of course earnings season really kicking into gear with a huge percentage of the S&P 500 coming out with their results this week. It was big tech down and rotation into the other stocks continuing as we saw the Russell 2000 hold up relatively well when compared to some of the markets. But it was really the flows and the data that were most important. And in today's video, we'll go through those. But if it's your first time here, remember to subscribe and smash that bell icon. So we'll start the story really here. And it comes back to sentiment. And of course, we get this report every Thursday from the AAII members survey. And it showed that most people, as of the Tuesday report, were really bullish on markets. 52.7% were bullish, and in general, we saw pretty much one of the lowest bear readings we've had in years. Remember, this was, I believe, the lowest bear reading we've had for a very, very long time. So with everyone basically going bullish, the stats were saying maybe we need to hold up there. The first 2 weeks of July might be the best, but remember this one. We've now had 7, which was 6, overall sells in the NASDAQ in the week of the OPEX, and that came true once again in 2024. So as we shared in our last video, Jason Gotford had some amazing data. Since 1971, we've only ever seen the NASDAQ lose 2% and the Dow go on to a new high twice, April 14th, 1999 and July 20th, 2023. So I thought what we'd do is we'd go back in history lesson to find out, before we go into some of the other data today, whether this led into a further fall off in the markets. And we go back all the way to 1999 to get started to understand. Now, if you're familiar with this, there's a couple of things I think that are worth noting. Number one, was it the end of the bubble? Well, in this case, no, the bubble actually went much further and more frothy near the end. On top of this, did we end up getting a 10% pullback? The answer is quite simply yes. Since we had the read, we ended up falling off over 10%, going around 12% at that point. So it could mean that we get to a point where we call mean reversion. And if you're not familiar with mean reversion, it basically means where the market comes back to the weekly 20 moving average. And as we move along, this red line, you'll notice is often well respected. Why? Well, it is the mean reversion. And this is a point where you want to be looking at, especially if you're a buy the dip style trader, where you're looking for Wall Street to give a response. Now, are we there yet? The answer is no, and in today's video, we'll see whether we could get a bounce off this zone, at least temporarily. But this is something that also occurred in July of 2023. A sell-off that went all the way back to mean reversion and then some, falling just around 10% from the top to the bottom during that point. Now, if you know your stats, you'll know that 2 times a year, you generally expect a fall off of around 5% plus. Now, we've had our first one, which was back in April, and we're looking now to see whether we get our second one. And the VIX has been predicting for a little while now that volatility would come in at the back end of July into August, into September, and of course it was all for this earnings. So if we believe that there's a chance that a 10% pullback could occur in these markets right now based on those 2 reads, then we have to also have a look at whether we expect the asset classes to continue to move forward and the buy the dip to be the situation. Well, in 2024 so far, some of the asset classes that have been doing the best are gold, the S&P 500, and of course the MSCI EM. Now, if you think about this, that basically means that we have a pretty decent market on our hands, and they usually don't stop just like that. In fact, what happens is they get wild near the end of bubbles, and that is not exactly what we've been seeing on the major indices. You might think it's wild, but if you go back and you look at other bubbles such as the Chinese bubble of 2015-16, or you look at something like the Japanese market in the 1980s into 90s, you would see that things can stretch even further. And that's not to take into consideration what happened during the dot-com boom. So the sentiment indicators, are they stretched? Well, Goldman Sachs has come out and said that their indicator went from being stretched to all the way back down in just 1 week. And basically this means that maybe they're a little bit light on and Wall Street could be looking at this as an opportunity. CTAs, on the other hand, basically are all looking quite weak, which is pointing towards a possibility of a negative gamma situation and therefore further selling, feeding into that possible 10% narrative that a lot of people are going to be bringing up. And it all kind of points towards, yeah, we might not be at the low of this current volatility just yet. However, US small caps did see something very positive. The largest fund weekly flow we have seen pretty much since the GFC. And this is a huge flow increase and of course showing us that breadth is really on the rise. Funnily enough though, when we last saw a big read like this, the Russell actually started to weaken and go sideways for quite a long period. And especially the read that we saw most recently, which was December of 2023, that actually stalled the Russell and it was over in just a few sessions. Could that be the same way? We'll look at that moment, but let's have a look at the sectors underneath the hood to see whether this market is truly sick. First up, it doesn't look like it. We've got a pickup of relative performance in industrials, energy, materials, real estate, financials in a huge way, and even consumer discretionary. And you'll notice there's a lot of hook turns going on here in the markets, which basically just shows you breadth is alive and well. What's doing badly? Information tech and communication services. So in one chart here, you can kind of see that there is a huge rotation going on. And because information technology and communication services make up the largest components of the market, it sends the S&P 500 hurtling down, along with, of course, the Qs, which are even more heavy in those particular stocks. What about the earnings season? What about the overall PE ratios? Well, you'll notice that there are still relative cheapness in the markets, in particular in the financial sector, utilities trading, I would say around the right levels, and real estate starting to come up. It's the infotech sector and the consumer discretionary sector that start to get a bit hot when it comes to the overall PE ratios. So let's now break down whether that means this market is looking terrible. Well, no, it's not. And the simple answer is because we've just seen breadth thrusts. Thrusts that you generally do not see without having continuation of a bull market trend. You'll notice in the reads here that they are incredibly bullish, often coming off extreme lows or coming off periods where the market will take a breather for a while, but it ends up going higher in the long term. And that's something that I think we need to consider here because this has a 100% track record over the last couple of reads all the way to 1962. And they are quite rare. I mean, we've seen a couple now. In 2023, we got our first one, which turned into a Zweig thrust as well, which is even stronger and of course has sent this market absolutely going bonkers. But we just got the new read. And if we have a 100% positive gain with an average return of double digits, that's not something that exactly looks like a negative market. And in an upcoming video, I'll actually give you an idea of where I think this market could get to before this so-called AI bubble ends up popping. S&P 500 also saw a 70 thrust, which is another extreme read. And in both cases here, whether it's the Wayne Whaley one or whether it's a 70 thrust, you'll notice that generally the market has to kind of absorb these particular reads. And it tends to have more weakness over the next coming weeks than it does over the next 3 months, 6 months, and 12 months. So again, the 70 thrust, more reads here, more data coming through, and in all of the cases, it was again bullish. So Whaley thrust, 70 thrust, pretty good. Another market that most of us should look at when we're thinking about freakouts in generalized terms is the bonds. Are the bonds trading good or are the bonds trading bad? Well, you can see here this chart from Grant Hawkridge shows that bonds versus moving averages are pretty much all above. And that again is pointing towards the general health underlying being okay. And this being more of a sell-off in huge technology stocks that could be seen as a buying opportunity should the right levels be hit and of course the right flows start to come in. This week marks earnings season, of course, as we've seen. And so far earnings season is living up to decent expectations with most things hitting, if not succeeding, and kind of bettering them. In particular, the banks were right on target, if not doing much better. And now we have the big one, Tesla and Google on Tuesday. Now, if you know anything about tech, these are the two of the most important ones. And of course, Tesla is fighting with a very tight range that we've been trading within and of course looking at from a positive and negative gamma flow. Google, on the other hand, is one of my pillar stocks. Google, NVDA, and Microsoft, some of my three top favorite stocks in the markets. So this will be an interesting earnings season. But look at the expectations here. A plus minus 9% on Tesla move and a plus minus 7% move from Google. It's going to be literally probably hundreds of billions of dollars floating around in just a few earnings results. And as we know, each earnings from this point on is probably just going to get more volatile and more extreme as markets start to expect a lot from these stocks. As we mentioned, most things are really living up to expectations, and you can see here that strong 2Q results from American Express as well. Revenue now at all-time highs and earnings up 44% year on year, which is pretty wild. Raising their full-year EPS guidance from $13.30 to $13.80 and maintaining a 9 to 11% revenue growth. So it's pretty clear that the debt market is doing well. And as we've long argued, the debt market and the building market are some of the most important to the long-term success of a overall stock kind of market's bull run, and more importantly, when it's actually going to crash. Are we seeing those signs? Not yet. VIX structure starting to really increase, and as we know, this has taken a few weeks ago. We expect it to really start in at around this point. So this is basically where you start to expect volatility, and it really gets exciting for a lot of day traders over the next couple of months. Let's now move over to dark pool liquidity. Then we'll have a look at the flow in terms of Wall Street's overall rotations, and then of course the S&P 500. Let's move through the cues here. Big dark pool transaction coming in right near the close. Now, often these dark pool transactions have led into further bulling price. We see one of the biggest ones here coming in back in April, leading to this huge run that we've had so far, and one huge one coming in right here. Now, that doesn't mean it instantly bounces up. You can see here they put a big position in, it goes down, traps some liquidity, and then ends up moving forward. But this is a good early sign that somebody most likely has moved into the market and they're looking at starting to build a position. It could be a sell, of course, but it's likely that it's overall a buy based on the current Movi flows and, of course, the general money that's in these markets. Another good sign is that huge trade we saw on the semiconductors the other day. Now, this is, of course, the SOX. So this is the short semiconductor market, and a huge trade comes in as semis fall off the cliff. Now, that is most likely a TP zone from someone trying to short semis. And I can see why they would want to short semis. We've been talking about weakness in semis for weeks now since we saw that huge sell-off. And it makes sense that someone would have a go at this. But what we'll want to see is a defending of this zone. Basically, semiconductors have come down to their first entry price. The mean reversion of the semiconductors versus the SPY, a code that we've been looking at for quite some time. And as you'll see later on today's video, it's currently potentially going to be defended, and we'll talk about that. Secular bull markets, one of the reasons we also think that this market's not quite over yet and it's more of a dip is because you generally see in all of the other plotted scenarios where we've had concentrated markets, that is a bubble forming, 60s and of course the 1990s, and then of course the 1929 point, we generally have gone further. So we've generally gone into what would kind of arguably to be like 2025, 26 before a problem occurs. Another reason why I think this market isn't going to fall off a cliff just yet is because when you think about it, the regional banks are doing well. The home builders are doing well. Energy's picked up, REITs have picked up, and REITs have been doing terribly up until this point. So was it an overall defensive market? Did we see XLP, XLV, and XLU be the 1, 2, and 3 of flows over the last 5 days? Well, the answer is no. And this tends to mean that overall the market is still good, and this is the pullback we had to have. And we always expect each year. Semiconductors are now down 9.59%. And as you'll notice here, even on Friday, they continued to get sold into that mean reversion level, which we can see as 2.9%. And it was a little bit more defensive on Friday. Healthcare, utilities, and staples were in the top kind of 6, 7 of the overall sectors. But again, I kind of stress here, regional banks, home builders, and REITs were still up there. And that kind of shows us that there is this rotation going on underneath the hood that's still pretty good. So did we expect this S&P 500 fall? Well, about 2 weeks ago, we kind of started to see stop signs. That is that one of these indicators was kind of reading into the concept of maybe we've moved a little bit too hot, too fast, and it's time for us to get a bit of a pullback. Now, we've seen a few of these, and you'll notice that it also happened in July of 2023, leading on to 2 more weeks, and then that pullback of around 10%. And in many ways, this helped us to kind of get an idea that markets were starting to fall off. But it was kind of the bears in control. Basically, the bears pushed down the market, and each day they managed to close it near the lows. And you'll notice the most important thing here is that the market managed to close below the daily 20 moving average. Now, we don't often see these closures occur. You'll notice over here on the 30th of May, we managed to hold that level and the market ended up bouncing back up. The last major pullback, March into April, we fell below, we saw a rally, and it ended up falling further until it found the proper buys. And this is because this is considered one of the first kind of major zones, and in particular, a zone where we see CTAs tend to move from being positive to negative. And CTAs are often momentum funds. So basically, if the market starts to turn, they will quickly start to clip their position, which is what Goldman Sachs was showing us before. Let's move over to the S&P from the perspective of the 20 moving average. And you'll notice here that we are not at the mean reversion. In fact, if we were to go down to the mean reversion, which would be pretty cool because it would be a good zone of dip buying, 5,300 would be the kind of level you were currently looking at. And that makes sense to the structure we saw back in May. So let's now look at the futures market. Does it all make sense there? So I've put in a couple of different things. Number one, if we're a day trader, it's a different kind of philosophy to, of course, an investor. And it looks like this 5,500 level is huge, by the way, when we look at puts coming in next week. Also, this is a stacked bull zone. I'll post this over on X so you can get a bit of an idea. But this zone here is not only one of the most traded zones, it's the expected options move flow down on Monday, which means that the market is expected to stay within this range 68% of the time. And we also know that this has to be defended, otherwise the bears will fully take control if they're able to push underneath the 54 kind of 45 zone, which we've long discussed as being one of the most important. So this area, absolutely stacked, couple of different fibs on it as well, couple of different anchored VWAPs, all sorts of different things. So in a level that we should be paying attention to. But it doesn't just stop there. The 5,500 is also really key. And you'll notice that when we have a look at the options market in particular, you'll see 5,500 quite well stacked with a huge amount of calls and puts, and then 5,400, and then that very important 53 we just discussed before, which turns out to be the heaviest put stack all the way down. So is 5,300 big? Absolutely. That is not only the 20-week moving average, but it also is the most amount of puts in the market sitting right on that zone. So this will be one that you want to be paying attention to should we get down there. What about Monday though? Well, it looks like we've got 5,500, 5,510 being the most stacked put level. And if this level is closed below, it could really send the market hurtling down. Maybe 54.45 might be the next target or around that most traded zone, because at this point, we would go into a heavy negative gamma situation. And we actually entered into one of those last week as we saw the market kind of take some of those key zones we talked about, including 55.75. So negative gamma is in play, and each day it's going to be 5,500 that really needs to be watched. So what about when we take a look at the August expiration, the big OPEX there? Well, that's sitting at about 5,400, and you'll notice again 5,400 comes up no matter which kind of date we're looking at, even the end of the week. So really, this market is in a chance of having what we call a waterfall moment, falling through, turning negative gamma, similar to positive gamma, but on the bad side, and falling all the way to the weekly mean reversion, which would also put us into that correction territory, which would make sense based on the stats that we've seen in previous times. What about the NASDAQ though? Was that agreeing when it came to CTAs? Well, both were dropping. NASDAQ CTAs were certainly dropping off, and S&P CTAs were dropping off as well. So Goldman Sachs is kind of correct. They were starting to dump positions. We also saw weakness across copper continuing to dump, and this has been a bit of a worrying sign. It really does point towards rate cuts coming, and more importantly, a potential weakness in the economy. Now, I've actually been pretty bullish on copper, so to see that get dropped through that level means that, you know, we've really got to reassess whether this thing can actually get strong over the next couple of weeks. Gold CTAs have been very, very good, and of course, I am very bullish on gold. I think it does well in stagflation, reinflation, and even cutting rate environments, but we did see a sell-off from this event. So what basically happened is CTAs bought up big time, they pushed to a new high on gold, and then of course it did dump into the weekend, which we'll look at soon. Brent overall, big movement up, and then of course a dump in price because price came back down. So it'll be interesting to see how that reacts. But in general, XLE, which is kind of what we're looking at the moment, the overall energy stocks, they held relatively well. Let's have a look at a couple of other overall GEX charts, in particular for NVIDIA. As we mentioned, NVIDIA stuck between that kind of 140, 115 zone. But in particular, I'm looking at 115 and 109. They will be key levels this week for NVIDIA, mostly because they're key technical zones. As we can see, if we go to the next expiration, when we hit into August, overall, the 109 is quite well stacked, as is the 115. So there's a lot of put wall stuff going on around this point. And if this was to be taken, then that would be worrying for, of course, a lot of bulls in the markets. When we move over to Tesla, it's kind of the same. 240 and then, of course, 265 plus break would create what we call positive gamma. At the moment, we're kind of in negative gamma territory, but we won't really fall through heavily until we get a strong close under the 240 to 230 zone. So be watching that this week as they are the most important strikes. 230, 240 for the buyers and 265 for the sellers. But if we get through 265, the market should absolutely fly at that point, and it would be very strong. Let's go into the lead indicators. As we mentioned before, bonds. High yield junk bonds, do they look bad? Not really. Yeah, they had a little bit of a sell-off, but still pretty good. What about my indicator on bonds? Still trading within the zone, so again, not worrying. And regional banks closed at a new high. So really, they have been doing quite well as well. So again, good signs underneath the hood. Home builders also showing good signs and a strong market. And US yields stuck within the range. So it's not like we've gone down further and said more cuts and more weakness or anything like that. We're sitting at around, I think, almost 100% chance now, according to the market, of a cut in September. But that's something that we're watching and, of course, looking at. Copper, on the other hand, was really bad. We did warn against looking towards a buy at around 440. And the main reason was, even though it was a 61.8 pullback and I liked the zone, we needed to see that buying point because there was so much sell pressure. And a lot of you messaged me saying, I'm short copper, haha. Now, fair enough. That's good. If you got into a trade like you were short, then this was a level that ended up falling through. And of course, the main thing here was that you were trading off the supply. So if you shorted up here, there's nothing wrong with that. But around this zone, it was definitely a possibility of finding a buyer. Now, what will happen next to copper? Well, it's pretty low. It's starting to get a little bit worrying because when you think about it, this is right in the 61.8 territory. Now, this is exactly where we kind of expected, copper to possibly fall to, but I would like to see some structure build up here. So we'll be watching that. It'll probably take quite a few sessions to get there. Let's move over to the dollar index. It ended up holding above the close, very bearish level, and therefore not really turning super negative, though I would think still at this point, rallies to be met by sell demand. Some couple of levels for currency traders, 104.50 may be worth watching on the overall dollar index for weakness. What about gold? Well, it's a melt up. We've got one high, two highs, three highs. Now, some people will be calling a Wyckoff on this because it ended up selling off and looking like that on the weekly, which we'll look at in a moment. But it has come back down to the daily 20 moving average. So this will be a very important level. As you can see here, we can now mark 24.83. And if that is ever closed above, we are going to go super uber bullish. And I think still this market does look good, although that is a horrendous close when you think about where it was. And it would have been much nicer to eke out a little bit of green coming into the weekend. It kind of suggests some selling to the start off of next week, and then hopefully we see some structure on the small side. I'm still bullish on gold, but of course for traders, you'd want to be looking for a little bit more. What about oil? Well, oil was definitely a disappointment. Came back down to the weekly 20, closed right on it. You'll notice the daily here came in with a nice strong daily close on Wednesday, thinking that maybe we got a bit more bulls. And the market came straight up to this high and found weakness there. And yeah, it is surprising to see it back down here. It looked okay in the start of the session and then sold and sold and sold by the end. So it's possible now we could go to 78 a barrel, and that might be where the next dip buyers are. Now, 78 a barrel, good zone. I wouldn't personally buy here. I would be looking at 78 a barrel or maybe a movement back up and above that 83.20. And it's those kind of fine lines that you've got to work as in the trader. Let's move over to energy stocks. Not the greatest weekly close, but certainly still holding up. And as we've thought for a little while, the energy stocks are probably the better position to be in for the long than oil. So still looking okay there. Now, CrowdStrike did really poorly. Of course, it fell off. I actually thought it might fall further. And you'll notice that what happened was it came straight into demand and then found a little bit of a buyer. So, of course, CrowdStrike, yeah, it's a little bit better there on the charts and something we're watching. But I wouldn't personally be buying the dip on that one. I think it's, a bit risky. And I know I really only included it because I know a lot of people wouldn't watch it. Let's move over to Tesla. So Tesla stuck within a range, 240, 265. 265 plus breakout daily. That's going to be huge. And at the moment, we're in what I would call a pullback in time. So as we saw in the options market, everywhere here is kind of where the demand is. We've got a daily 20 moving average catching up with the markets. And at the moment, it is a little bit weak because, of course, it's made a lower high and it's coming back down. What we really want to see is this if you're a bull buyer. If you're a bearer, you want to see it take that 230, take the daily 20 moving average, and then come to fill the gap, which will be around that 61.8 fib pullback, which is probably the next buy zone. So, yeah, it's a bit unclear here for Tesla. This is what you kind of have to expect when you hit a key technical zone, but its earnings is coming up, and that's why it'll stay within the range, and then the earnings will kick it off. And I think this is one where you can have the patience to react to the earnings. I think getting in before the earnings might be the bad mistake. That's kind of like gambling. I feel like the after earnings might have more edge on it. We'll watch that one this week. Semiconductors versus SPY, one of our favorite combo codes, coming back to mean reversion. We know that this is hit 1, 2, 3, 4, 5, 6, 7, 8, 9 times. And comparatively to the SPY, semiconductors have found buying pressure. Now, that doesn't mean that semis have to bounce here. And we'll go back to this chart for a second and put in NVIDIA. It just means that comparatively, it'll fall within the SPY. So if the SPY falls 1, semis would fall 1 as well. They wouldn't fall more if they were to hold that particular moving average. But you might notice here with NVIDIA, I've got a key bull zone sitting around 109, 1010. Now, I would like that level to be hit because if that level gets hit, it's a pretty good structure zone and it would certainly make a lot of sense. But you'll notice we've gapped down, we've sat here for a few days. If NVIDIA comes out with a strong gap up, then that is an island reversal. So something to be thinking about, 120 first target, 110 kind of second target. So it's on the first buy pressure. The second buy pressure is around here. And a lot of traders will be looking at it. Does it look like the end of a bubble though? I don't think so. And the main reason is because even though it has fallen off, don't get me wrong, it's not really done something that's absolutely insane yet. If you think about bubbles, generally speaking, they will go absolutely ballistic near the end. Now you could argue, well, that's ballistic. From over here in the period of April to here, you can't have an 80% up system without that. That's just wild. But yeah, you'd be surprised if you have a look at some of these stocks. They are absolutely insane. And remember, this is currently backing it up with forward earnings. So that's the key thing. Yes, it's detaching from reality, but never forget that it's still trading within its 5-year forward PE average, okay? So if it's trading within that and living up to expectations, what we're looking for is one standard deviation above that level. And that will tell us that we're in true epic bubble kind of levels. HSI, Chinese stocks, really poor weekly close. After last week, you would never think that you'd be around to this level, but I think the events of last weekend and the tariff kind of threat has pushed this down. It's a wait and see on this stock market. I mean, China obviously I think is short squeezing. Still think, we obviously got bullish on it over here. But yeah, I would have never thought after close like that we would be like this. So this is certainly a key bit of news that's affected the markets. And I'm still looking for some kind of bid. And there's just not enough bid here on the charts. We'll keep following it. US 2000, resistance into pullback, first level 38.2 and anchored VWAP, sitting right on support, similar to kind of what the S&P 500 is doing, sitting right around that put support. Maybe some buyers here. Second buyers would be about 21.10. So it's possible the Russell comes down a little bit more before it goes up. RSP, big rejection. Not a great sign. Certainly now we can really tell when the bulls are back in control though, because of course if this is closed above, that's going to be a huge deal. And I don't mind it because ultimately you're going to get some great reads coming forward. So some exciting trading coming through. Let's now move over to Bitcoin because Bitcoin has done everything we could really want from it so far. We expect it to be strong. We kind of went bullish on it in here. Definitely expected this. After we expected this, we kind of think that there may be a pullback. But in general, this market looks really strong and it's starting to put the odds in our favor of moving towards an all-time high, 80, maybe even 90,000. So realistically, Bitcoin is really improving here on the charts. And while it's showing a sign of temporary weakness, I think it's quite strong across the board. What about the news for the week ahead? Well, it's mostly earnings season this week. And as you can see here, a lot of the news is coming out for other countries. But we have PMI on Wednesday, and on Friday, we have the core PCE index. If you enjoyed today's video, guys, and you enjoyed the weekend summary, then please remember to subscribe and smash that like button. And also check out our 7-day free flash sale if you're interested in finding out more about how we rotate in markets and find opportunities. Check out us on X. And of course, in terms of the overall sentiment, I just want to reiterate, I don't think you need to be too freaked out. It's expected that semis were going to drop. The stats point towards weakness at this point of year, and of course, volatility increasing. If we start to lose some of the key supports, that's when you want to pay attention to it. But a 4-5% pullback in those markets, it's not enough to be worried about. Thanks so much, and we'll see you next week. Bye for now.